Hello everyone, welcome to Brilliant Bankers. In today's session, we will be discussing about the international equity and debt products, wherein we will be discussing about the regulatory environment, about the ECBs, about the trade credit, about GDRs and the IDRs. The main intent is to understand the overview of the funding options available from the overseas market through the instruments of debt and equity to an Indian entity. So let's start off with the regulatory environment. The international equity and debt products, which refer to as the financial instruments that provide investors with exposure to equity and debt markets of the countries other than their own. These products allow investors to diversify their portfolios by gaining access to a broader range of investment opportunities across the different regions and markets. So, foreign investment in India is which is regulated by the FEMA Act 1999, read with the Forex Management Regulations of 2017. There is a foreign exchange management, transfer or issue of security by a person resident outside India, Regulations 2017. This explains foreign direct investment or the FDI is defined as that FDI means or the foreign direct investment means investment through capital instruments by a person who is resident outside India in an unlisted company or in 10% or more of a post issue or a paid up equity capital on a fully diluted basis of a listed Indian company. What is FPI? The foreign portfolio investment. It is any investment made by a person resident outside India in capital instruments where such investment is less than 10% of the post issue paid up equity capital on a fully diluted basis of a Indian listed company or less than 10% of a paid up value of a series of capital instruments of a listed Indian company. And who is a portfolio investor? Is a person who is registered in accordance with the provisions of the SEBI regulations 2014. So, foreign investment is any investment made by a person who is resident outside India on a repatriable basis in capital instruments of a Indian company or to a capital of a LLP in India, that is a limited liability partnership in India. There are some prohibited sectors wherein these investment can't be done, and some of the common type of the international equities and debt products are like the international equity funds, the American Depositary Receipts, the Global Depository Receipts, the global and the international bonds, the foreign currency denominated bonds, real estate investment trusts, the sovereign debt instruments, and a few more. So let's know or understand what are the prohibited sectors or the persons who can do a trade or a investment through the foreign direct investment mode. An investment by a person who is outside India is prohibited in some conditions, like in that of a lottery business, which is including the government or a private lottery or even online lotteries. The gambling and betting games, that is including the casinos, they can't participate in any chit funds except for an investment made by NRIs or OCIs on a non-repatriation basis. So NRIs or OCIs can invest in a chit fund only in a case that the amount is not repatriable, not in a Nidhi company. They can't invest in any agriculture or plantation activities or in a real estate and in construction of farmhouses. They can't indulge in trading in transferable development rights and also in the manufacturing of cigars, cheroots, cigarettes, or of a kind of the tobacco or any of the substitutes for tobacco. And the persons who are prohibited from entering into a foreign direct investment in India are a person who is a citizen of Bangladesh or Pakistan or is an entity incorporated in Bangladesh or Pakistan is not allowed for any trade. And if they want to do any trade, they have to be given a special permission for the same by the government. And if an permission has been given for the same, then they can invest in all sectors other than that of the defense, space, atomic energy, and few other prohibited sectors for the foreign investment. So let's discuss about the ADRs and the GDRs. What is an ADR? It's an American Depository Receipt. What is a GDR? It is a global depository receipt. These depository receipts are certificates issued by depository banks or the financial institutions outside the company's home country. The depository banks holds a certain number of shares of a foreign company's stock and issues JDRs in the international market, representing ownership of these shares. They are issued by a depository abroad and are traded in overseas market, which are negotiable receipts. GDRs are typically listed and traded on the international stock exchanges, such as the London Stock Exchange and the Luxembourg Stock Exchange. And ADRs are listed in the New York Stock Exchange. Investors can buy and sell these depository receipts just like regular stocks, providing them with a way to invest foreign companies without directly accessing the local stock exchange. The currency denominations that is mainly used for the ADRs and GDRs are the US dollars and the euros. So, in all, the depository receipts provide companies with an opportunity to tap into the global capital markets and attract international investors. Investors benefit from the increased liquidity and the ability to trade foreign securities without having to deal with the complexities of the cross border transaction. Depository receipts also provide companies with an opportunity to tap into the global markets and attract international investors, wherein the investors benefit from the increased liquidity and the ability to trade foreign securities without having to deal with the complexity of the cross border transactions. On the whole, the depository receipts offer a mechanism for companies to access international capital and for investors to diversify their portfolios by investing in the foreign stocks. Coming to the next one, which is the IDR or the Indian Depository Receipts. These are financial instruments that allow the foreign companies to raise capital from the Indian capital market. They are similar to that of the global depository receipts, but are specifically designed and companies issuing them in the Indian market. IDRs represent the shares of a foreign company and are listed and traded on the Indian stock exchanges. And coming to the overview regarding the issue and the purchase of the IDRs, the foreign companies can issue IDRs in the Indian market to raise capital. That is, a company incorporated outside India may issue IDRs through a domestic depository to a person resident in India and a person who is resident outside India also. They have to comply with the Company Rules 2014 and the SEBI regulations of 2009. And all these ideas that are issued is denominated in the Indian rupee. The issuing company needs to appoint a domestic depository bank in India which holds the shares of the foreign company and issues IDR against them in a normal case. Or what is the purchase or what are the formalities for the purchase or sale of an IDRs? Investors in India can purchase, that is a FPI, NRI or OCI may purchase or sell IDRs and also from funds. It can also be from the funds held in the NRE or the FCNR account of the NRI. So they can purchase, hold or sell the IDRs. It can be from the funds that is held in the NRE or the FCNR accounts. So investors in India can purchase these IDRs through the primary market when they are initially issued by the foreign company. Subsequently, they can also be bought and sold in the secondary market like the regular stocks. The purchase and the sale of these IDRs are facilitated through a stock exchange where they are listed. So the maximum cap for issue of a IDR by a foreign company in Indian market is up to an amount of US dollars 5 billion. So how do you transfer or redemption and what are the two-way fungibilities of IDRs? The IDRs can be transferred between investors in a manner similar to a transfer of shares. This transfer process is recorded by the depository bank in India and the ownership of the IDRs is updated accordingly. The redemption or the conversion into the underlying equity shares to comply with the foreign exchange management. There is a transfer or issue of any foreign security regulation 2004. It shall not be redeemable into a underlying equity shares before the expiry of a minimum period of 1 year from the date of issue. Any listed Indian company or an Indian mutual fund that is registered with the SEBI may either sell or continue to hold these underlying shares subject to the compliance of the foreign exchange management regulations. There is a transfer or issue of any foreign security regulation of 2004 and a resident in India can hold onto these IDRs for a maximum period of 30 days and that can be only for the purpose of sale only. On the whole, these IDRs offer a mechanism for foreign companies to access the Indian capital market and for Indian investors to diversify their portfolios by investing in global companies. The regulatory framework ensures that the issuance and the trading of IDRs adhere to the established standards and protect the interests of these investors. The next two topics given in the book are the external credit borrowings and the trade links. We have already discussed about ECB and the trade credits in detail in our earlier sessions of module A. The link for the same will be posted in the description of this video for easy access. Kindly go through those videos so that you can easily understand what is an ECB, that is an external credit borrowing, and a trade credit. If you are liking the subject and the content of this video, please do like, share, and subscribe our video. Coming to the last topic, the rupee denominated bonds. Rupee denominated bonds. Banks in India are permitted to issue rupee denominated bonds overseas. They are commonly known as the masala bonds and are debt instruments issued by the Indian entities in international markets but denominated in Indian rupees. These bonds allow the Indian businesses to raise capitals from global investors without exposing themselves to the foreign exchange rate risk. The term masala bonds was coined to reflect the Indian character of these bonds, similar to the spices associated with the Indian cuisine. So, some of the few key features and the aspects of the rupee denominated bonds are like Indian entities, including the corporations, financial institutions, and government bodies, can issue the rupee denominated bonds in the international markets. The issuance is conducted outside India, typically in major financial centers like London and Singapore. By issuing the bonds denominated in Indian rupees, Indian entities aim to mitigate the currency risk, which is beneficial for both the issuer and the investor. because it reduces the exposure to fluctuations in the exchange rate. These bonds, the masala bonds, are available to international investors who are interested in exposure to Indian financial markets. These investors include sovereign wealth funds, institutional investors, and other foreign entities. They are listed and traded in international stock exchanges like that of the London Stock Exchange and the Singapore Exchange. That is the LSE and the SGX, which are the common platforms for listing of the rupee denominated bonds. The issuance and the listing of the masala bonds are subject to the regulations set by both the Indian regulatory authorities, the RBI and R and the regulatory bodies of the countries where the bonds are listed. The regulatory framework aims to ensure the transparency and protect the interests of the investors. It also attracts foreign capital by providing a way for Indian entities to tap into the global capital markets and attract foreign investments. This can particularly be useful when domestic interest rates are relatively high, making the bonds attractive to international investors. It is eligible the eligible amount for the purpose of issue of the perpetual debt instruments in foreign currency shall be higher than that of 1.5% of the risk weighted assets and the total additional tier 1 capital of the company or the bond that is being issued, and the maximum limit or the eligible limit for the issue in foreign currency is 49%. So, rupee denominated bonds contribute to the internationalization of the Indian rupee and enhance the depth and breadth of the Indian capital markets. They also offer a way for Indian businesses to diversify their funding sources and provide international investors with an avenue to participate in the Indian growth story. With this, we end this chapter, the international equity and debt products. In our next session, we will be discussing about funding and the regulatory aspects. That is the reserve assets, CRR, and the SLR, and also the liquidity adjustment facility and the payment and settlements systems. If you have any questions or comments, please feel free to leave them in the comment section. Your feedback is very invaluable to us. Do not forget to like, share, and subscribe our channel, The Brilliant Bankers. This is Nishan signing off. Have a great day. Jai.